I remember seeing my name and seeing over what my bankers were saying. This is what you're worth on paper when we go public.
Yeah.
And I'm like, that's more money than I even knew existed in the world.
Yeah, exactly.
And we were getting ready to go and file, and then the market popped. So we missed our window. For any founder that doesn't shed a tear from time to time, they're not a true entrepreneur.
Yeah.
But I remember dark nights, looking at the ceiling going, what the hell am I going to do?
Today, we have an awesome guest, Andrew Smith, the definition of a problem hunter.
Yeah. I see a problem and I'm like, that's stupid.
Yeah.
There's probably a better way, and then I create something.
But people need to understand that's where the greatest ideas come from, is when the entrepreneur actually feels the pain.
He feels the pain.
He's trying to solve.
We were at a race. We're actually on track side. Our zippers were down on our race suits, and we were having a cold drink, and we were just waiting for our next race. And he said, tell me a little bit more about the business and how you're funding them. And so I told him the whole shtick. He said, well, have you ever thought about doing this in a private equity stand-up structure, institutionalized structure? And I'm like, I've thought of it. I just haven't done it. I'm too busy. I mean, we were doing $200 million a year in sales and busy and big teams a lot. I'm like, I'm not going to go figure that out today.
Yeah.
He goes, well, that's what I exist for. I'm like, okay. And he goes, why don't you just partner with Mercado? We'll stand all of it up, use our institutional backbone, our name, but it'll be standalone. And I'm like, cool. So I shook his hand.
Yeah.
And we formed Savory that weekend when we were racing.
Welcome back to the Startup Ignition podcast. Thank you so much for tuning in and listening. We appreciate every single one of you. It has been such a fun adventure. We're meeting awesome people. I hope we're sharing awesome advice and tips, but give us feedback. Let us know in the comments what you're wanting to listen to, what you're wanting to hear about, what kind of advice and mentorship you want to hear about. But today we have an awesome guest who has been so gracious to give us an hour of his time because he's such a busy dude, literally coming from deal making, probably going to deal making.
I was actually deal making.
I know. And we have Andrew Smith, who is the founder and an investor, a managing partner of a fund. He has been an operator, an entrepreneur, going from tech to restaurants, which is an awesome transition that I definitely want to dive into. Yeah. Currently, you were in early tech ventures and doing a ton of things on your own, which I looked at your LinkedIn. It's very extensive, to say the least.
Yeah, there's not a lot of resumes I put together in my life.
Yeah.
I haven't needed a job, so I just create them.
But you've also been now at Savory Fund for I don't know how many years, but I know that it's been around for a while now. Yeah. I don't know what fund are you on?
We're
now?
on Fund 3 now.
Fund 3.
Fund 3, about 70% raised on our next fund, $200 million.
And for those that don't know, Savory Fund is a restaurant-focused fund that are responsible for the brands, at least here in Utah, and probably national at this point. Yeah. Like Swig, Mobetta's, R&R Barbecue. What else am I missing in there? Via 313, which is a very big favorite of ours.
I keep turning people on to Via 313.
We keep going there.
It's an easy one to turn them on to because when they go, they're going to like it.
Everybody loves the pizza, and they go, and the salads and everything are so fresh.
And Andrew, we go, hey, we're investors in Savory Fund, and they throw us some free cinnamon bread.
Oh, good. Yeah. Make sure you do.
You're investors?
I would do it too.
Yeah, so a disclaimer on this is I'm an LP in Savory Fund.
Yep. But also now you've raised a ton of capital. So you've also been on that side of the table. You've deployed capital. So just all around amazing, awesome, wise, just been around the block, dude. So thank you, Andrew, for coming on the podcast. This is awesome. But before we dive into everything, and I want to ask you a ton of questions, of course.
Okay.
On our podcast, we always do like a quick icebreaker.
Kids do it.
Which
Love
is like
icebreakers. We actually start all of our executive meetings with icebreakers.
Do you?
Oh yeah, all the time.
Yeah, it's just a good way to get in the mood.
It's a good way to get talking.
Yeah. So real quick, we're gonna do a brand blitz. I'm calling it because we're a little food focused here because of your background. I had to go.
Even if you wanted to do a tech one, I could do a tech one.
Yeah. Well, I actually have tech in here too. So here we go. I just want you to. I'm gonna do two popular consumer brands, and I want you to tell me which one you prefer over the other.
Just him or me too?
You too.
Okay.
You guys can both do it.
John.
Okay, here we go.
If we sync up.
First one: Chipotle or Chick-fil-A?
Chipotle.
That's interesting. I'll probably go Chick-fil-A only because
this is a hard decision.
My grandkids absolutely
the kids love the Chick-fil-A.
Oh my gosh. And if they got a play place in there, they think they died when they had it.
And Chick-fil-A is defying the odds.
Yeah.
They're doing a lot of things.
But I like both, yeah.
Okay, next one. Yeti or Hydro Flask or either?
Hydro Flask.
Hydro Flask.
Yeah, I've got them.
Hydro
They're
Flask,
amazing.
Yeah. Do you have a Hydro Flask?
I have both of. I have
The crazy thing is that you think, how can you continue to come up with new ones,
Yeah,
right?
yeah.
And then you get the Hydro Flask, and you're like, holy cow, this is the best one I've
The Hydro Flask.
yeah,
it's
yeah.
amazing.
Here's a fun thing. If you have to travel with something that needs to be refrigerated or kept very cold, those are the two leading ones. I researched this big time.
However,
they maintain the coldness. The
I do
longest.
have a Yeti, and literally today I was talking to someone about it. I take it to Lake Powell every year because my family, we all go, so everybody stuffs the refrigerator and freezer full of their own crap.
Yeah.
So I told my wife one year, I'm like, I'm taking my own cooler, having my own chocolates, having my own yogurt, and I keep it on the back deck. It's cold for 4 days in the middle of Lake Powell.
That's incredible.
With 2 bags of
They
ice,
both
4
are great.
days.
They retain.
It's crazy.
even down to their flasks.
But
right?
anyways, so okay, next one. Uber Eats or DoorDash?
DoorDash.
DoorDash.
DoorDash too. Yeah.
Uber, they are, they're the worst.
Are they?
Yeah, on our side too, to work with them, it's the worst.
Oh, I'm sure.
DoorDash is great to work with.
Yeah, from the operator side,
Yeah,
I'm sure
but
it's
from
annoying.
a consumer side, DoorDash.
Yeah. Okay. Apple or Tesla?
Apple.
Apple.
Yeah, I got a Tesla. I like my Tesla, but Apple's really good. That's a really.
It's not really comparative. I don't know why I did that
I think
one, but-
Apple should have bought Tesla.
Yeah, so do I.
And
Well, what
because
if- what
Tesla's
if-
like the Apple of cars.
No, but what if Apple would have come out with a car? Would you have bought an Apple car or a Tesla?
It'd be interesting. I have to see what the
I know.
Apple car was,
Because
right?
they
Yeah.
were going to do it for a while, and I'm like, that's going to be
Well,
interesting.
Apple acquired Beats by Dre.
Yeah.
Remember that?
Yeah, yeah.
And I
And then
feel
they-
like that was an amazing investment for them. It kicked off Apple Music for them.
It was incredible. And now they have their own headset.
Have you
Yeah.
heard about the latest though with Tesla? Tesla's just really ahead on a lot of stuff. Like, for instance, the battery. They just came up with the aluminum ion part, which
saw
could
that.
make lithium not have to.
Yeah.
And the much lighter battery. Yeah, and it's
gonna be incredible.
Charges faster, holds better. Anyway,
Okay, we
interesting.
got a few more here.
go
Here we go.
Let's go.
Netflix or HBO?
Netflix.
Netflix. In-N-Out, Shake Shack.
In and out.
In-N-Out.
You
like Shake Shack?
I like them both. In-N-Out's probably got a hair edge.
Yeah, I like In-N-Out. I think they're doing things right. Okay, Starbucks or Dutch Bros or neither?
Dutch Bros.
Dutch Bros.
Really, I've never been to Dutch Brothers, but Starbucks I've gone to, so I'd probably say Starbucks.
Okay, Nike or Adidas?
Nike.
Same, Nike.
Yeah, Nike.
Instagram or TikTok?
Instagram. I don't even know what TikTok is.
Oh, come on.
And all my team uses it.
Come on,
we
Andrew.
market on it, but I just don't use
The
it.
Gen Z, come
I know.
on. Embrace the Gen Z within.
The good thing, to me, that's a true 50-50 because Instagram's got the legacy. And
He's
they do
on
things well.
TikTok. He's on TikTok.
You're
Come
on
on now.
TikTok.
I'm not on TikTok. Well, he's putting me on TikTok, but TikTok is you can, as somebody who's trying to get a message out, it's much easier on
yeah.
TikTok
It
than
actually
Instagram.
is.
Yeah,
It is.
the growth and like the algorithm just works in your favor.
If you went in and did some of your restaurants on TikTok versus Instagram, I bet you TikTok would get more
Oh no,
traction.
TikTok is that's
Your
where we're
your
getting all
brands
of
are
the
probably killing it.
It's exploding with Swig, Mobile on
yeah.
TikTok.
Yeah,
not as
yeah.
much on Instagram.
Yeah.
But
But
as
I think
a
for personal user,
Yeah,
I'm
personal
more
user,
of an Instagram
family,
guy.
Instagram for sure.
But is it also a thing that it's going to be like the younger generation's TikTok, and then Instagram is we're using that now, and then it's going to become the Facebook, where people are like, Facebook, who the hell uses Facebook?
They
No
are
one uses
different.
Facebook.
Instagram.
Yeah.
Instagram.
I don't know.
Instagram's for family and personal. I've never put
Yeah,
anything
yeah,
on
I agree
TikTok
with
that
that.
I want my family to look at.
Yeah. I agree with that.
Okay, thank you. That was awesome. We got to
Yeah,
know
it's fun.
Andrew really well there. We know that he what did you say, Chipotle or Chick-fil-A?
Yeah,
I don't even
Chipotle.
remember. Yeah, Chipotle was the
In
first
and
one.
out, in and out.
And In-N-Out. There we go. So if you ever want to brown nose Andrew, bring him some In-N-Out.
No, but they were interesting questions because when you ask them to me, you're thinking of it one way as a consumer.
Yeah.
I'm always thinking about it from the people I know there, how they're
Yes,
running their
exactly.
business,
That's
why
cool.
they're excellent.
Yes, yeah.
So my mind went immediately to how they're doing it right from a business standpoint.
Chipotle's a brand I could see you owning, right? If
Oh
you-
my gosh.
that
It's
type
just,
of thing,
everybody wants to own that.
Yeah.
Not In-N-Out's not really your kind of brand.
So, okay, Andrew, take us back. Where does this begin? Like, because your background, starting in technology, moving into restaurants, moving into food. Where does it begin for you? Like, go as far back as you want to go.
Yeah,
Pre-college, college, post-college, wherever.
So I was born in Chicago, so I'm not a native Utahn.
Oh, really?
Yeah. And my dad was a professional. He was a doctor. He was a dean of a dental school out in Northwestern, and so I always grew up thinking, well, maybe I have to be a medical doctor or something because that's what my dad was, and that's what you do when you have a dad that's doing something. You're like, maybe I should do what he's doing. It's
The
successful.
apple doesn't fall too far.
And my other siblings did follow him in that. And then one of my siblings went to MBA, got his MBA or her MBA. And I thought, well, I got to pick. And my dad was always like, you got to pick something where you're always going to be needed. And I'm like, yeah, I should do that. Well, I didn't do anything like that because business is not something you need all the time. But I decided to leave Chicago and come out here to Utah because we had cousins in Alpine. We would come out every other summer or
So
whatever
you
and hang out.
visited.
So I liked Utah, and I'm like, I can't be in a city where my father's Dean Smith.
Yeah.
So I'm going to get out of the city.
Yeah.
So I came out here and went down to BYU land and went to school. And I was business major with finance as well. And I had a roommate at the time that was a computer science engineer. And
Yeah.
he came home one night, and we were in our apartment, and we were watching this Jaguar commercial. And he said, how much do you think it costs to put that Jaguar commercial on TV? And I'm just like, I don't know, probably 250, 300,000, to create it and the film and everything else. He's like, wouldn't it be cool if you could put that on the internet? Now, you have to think about the time too, because this is 1998.
Oh, yeah.
So you think about it, like there was just not streaming media.
Yeah,
And so I'm like, yeah, that would be really cool.
Yeah.
He goes off and works with it with his classmates, comes back 2 months later and shows me that Jaguar commercial on the internet. And I'm like, what? It blew my mind. I never thought I was going to be in tech. I thought I was going to go be a finance guy, right? And I saw that. I'm like, well, we should call Jaguar and see if they want to buy it from us. And so we just started calling Jaguar nonstop. Jaguar USA. I probably called them 400 times. And we finally got someone on the marketing department to call us back. We were sending them the link, and I could hear them. It was the phone with the little thing to the wall, though.
The cords. Yeah.
And I just said, hey, I'm going to send you a link. I want to show you something. I could hear them hearing their commercial on there, and they're like, what is this? I'm like, well, it's your commercial on the internet. And they're like, well, I can see that, but how'd you do it? I'm like, well, you're gonna have to buy it if you want it, And they said, well, how much does it cost? And in my stupid head, I'm thinking, I'm 23 years old. I'm like, $125,000. I mean, I didn't know. And they're like, that's great. How many times do we get to use it? And I'm like, wait, that's just to use it? I thought I was selling it, And they're like, yeah, how many impressions? And I'm like, what the hell does that mean? Like, I did not know anything.
Yeah.
I'm 23 years old, right? I'm engaged. I'm ready to get married. And I don't know. I'm like, I'm going to be rich at $125,000. And they're like, no, that's just to use it. And I hung up the phone. I'm like, I think we have a business. And so I started talking to my professors and how do you set up an LLC and how do we raise a little bit of money? And we literally signed Jaguar USA as our first client.
Really?
And then we went to BMW and created one for them and signed them and Mercedes and Citibank and American Express. And we were just shooting fish in a barrel because streaming media was so new.
Yeah.
And at the time, I didn't think that was going to be coming. We were a full-fledged company, raised a friends and family round, was taught how to do that by asking around, raised a venture round of $3 million. Wow. And we were a legit company. Down in Provo in the Salmon buildings, right there in Riverwoods. That's where we were. SNet was right above me.
Oh, wow.
And we had a business.
So what was it was just hosting web
It was
video
streaming
hosting?
media. So we actually had a codec that we built. So it was our code base.
Yeah.
And we patented it. And we went to everybody that had commercials and said, we can put your commercial on the internet and then you can serve it up to all of your customers that are existing customers to promote something else within your product line or new.
Yeah.
And the one that the car companies wanted to do is they wanted to promote, like today, come and drive a Tesla or set up a test drive.
Yeah.
So we set up a test drive for the new X-Type Jaguar. And they set up like 19,000 test drives through our technology.
Yeah.
So it just was blowing
And that was just
people's
unheard
minds.
of
No,
back then.
nobody even knew about it.
Yeah.
So we grew that for a couple years and we were growing like a weed. We were exploding.
What was the name of it?
It was called Capture Quest. So the quest to capture your
Did you ever
attention.
hear a Real Video?
Oh,
'Cause
yeah.
I was
Oh,
from
no.
Seattle. Seattle from like 98 to 2000. Real Video was trying to figure out a lot of this too.
Oh yeah. Real Video was one in the same time as us.
Yeah.
There was Interstitial in New York, and then there was Mind Arrow Systems in Southern California, and then this other pesky guy in Texas named Mark Cuban.
Yeah.
And so we were all vying for the same.
That's Broadcom. Yeah. Sold to Yahoo.
That's right.
That's
Sold
how he
to
got his
Yahoo.
billion, right?
And so I watched that, and I remember watching that, and I'm like, oh my gosh, we're worth $1 billion. Yeah.
Yeah.
Interstitial went public. Mind Arrow System went public. We were pre-IPO. And guys, I'll tell you this, and even for the people that are listening, I remember seeing my name and seeing over what my bankers were saying. This is what you're worth on paper when we go public.
Yeah.
And I'm like, that's more money than I even knew existed in the world.
Yeah, exactly.
And we were getting ready to go and file, and then the market popped. This was 2022.
And what did the IPO fall?
2002.
It never went?
No, so we missed our window. So I
from
remember,
2000 and 2001 were tough. 911 really hurt things.
Yeah, really hurt things.
In 2002 was almost impossible.
It was toast. You couldn't go out.
Doesn't matter how
market
good your
popped.
company was.
Didn't matter.
Impossible.
But the thing that was good for us is this, and this I would say for anybody, and I sit in front of entrepreneurs all the time, and I say to all of them, like, you got to get back to fundamentals and not just think about, just grow it. It doesn't matter if you are profitable or not, and then someone else is going to come and give you a higher value, because if someone's not going to give you a higher value, you're screwed. So for us, we were always like, let's make sure that we're as close to profitable as possible. And then let's make sure that we have not all of our eggs in one basket of one client either. You can't have 80% of your concentration of your revenue in one client.
No,
so we
right.
were nicely spread out. So we still had people paying their bills and still marketing during that time. So we survived the dot-com bubble. A lot of them was vaporware. So they were the ones that went away. And 6 months later, one of our competitors in Southern California said, well, we're already public. There's a consolidation going on. You should sell to us. And I'm like, makes sense. So it was a fraction of what I was going to get when we were going to go public. But in my own right, in my mind, it was an incredible
Stock or
success.
cash deal?
Stock and cash.
Okay.
Got stock. Stock was good. We had, think about the time too, John.
Yeah.
This is 2002. We had 36 million in combined ARR. I mean, it was a good size number.
Wow.
And so I was VP of sales, 26 years old, reporting to the street, hated it.
Yeah.
It was just not me. I was an entrepreneur. I was not, the spirit of entrepreneurship was gone out of the office. And so that was when I decided to leave that.
When you sold into that other company, that's when it got bad and you didn't like it?
It's not bad. It was great. Like things were going well, like I told you, and the market was stabilizing. I'm just saying for me, I realized I was an entrepreneur. I like that, the growth feel of it.
The ground up feel.
The ground up and just the camaraderie and the culture.
There's a certain number of employees
grittiness.
where you start not liking it. And you're like me. And also, I went through an IPO as well, roadshow, all the stuff like that. And the East Coast financial world's a different culture.
Different, totally different.
And it wasn't my favorite.
No, it's not. And listen, it is for some people, and people dream of it, right? Tyler, you're like, I cannot wait to go ring the bell and something. It's
like
just
being
never
an
been
M&A
something for me.
Yeah, being an investment banker, M&A guy in New York City is a dream of a lot of people. That lifestyle's...
It's rough.
I'm sure you were watching that Broadcom, Mark Cuban stuff. You're just like, dude, I cannot believe the value we're holding here.
And
then the
honestly,
feeling you
before
had
the
when it
dot-com
collapsed.
Before that bubble popped, I was like,
Riding high.
I'm the next Mark Zuckerberg. I'm like, that guy didn't even exist.
Because I think a lot of experienced entrepreneurs get to a point where they are acquirable or where there's an exit palpable. And I feel like if you are distracted by those kind of things and move off of the main business model, it's tiring. It's taxing.
Very tiring.
It's like, taxing. If you were like, I just saw Mark Cuban do that. We're about to do IPO. Boom, all of it collapsed. I couldn't imagine what you were feeling.
The problem was
I'm not trying to bring up bad feelings, but you're like, man, that's hard.
It's back to the cycles though, Tyler. 2001 to 2003 was awful in the tech industry.
It was awful.
Yeah, I mean,
it was awful.
I've told you about that. We've talked about it. It's just literally you don't understand how dead it was because the bubble burst and then a year later 9/11 happened. It just went into the pits.
Yeah. It did. And it felt, listen, it was a lonely time. As an entrepreneur, I mean, I'm not ashamed.
There was no venture investing happening.
No, everything stopped.
Out of the rubble of the dot-com crash, a lot of new things emerged because it had to, because it was such a bad crash.
Yeah, it was such a bad, it was cataclysmic. And I would say that for any founder that doesn't shed a tear from time to time, they're not a true entrepreneur.
Yeah.
But I remember dark nights, looking at the ceiling going, what the hell am I going to do? This is scary.
So where did you go? Where did you go from there? Like what happened?
So I was there for 3 quarters and then I had already an idea because I took some of my money and I went to an RIA and I said, here, invest my money.
Yeah.
And I said, I'd like to see with my money what you're doing with it here, 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 and here. And essentially nowadays, Power BI, give me a dashboard and show me everything what we're doing.
Yeah.
Well, we don't have that. I'm like, what? What do you mean you don't have that? And they're like, well, we don't have a software like that. I'm like, well, I'll build it.
Yeah.
So I actually got a couple of my developers and we built the technology for RIAs, and that was my next business.
Oh, wow. So it was like a personal investment dashboard, basically?
Dashboard for RIAs. So your advisors would actually use it, load up your information with your stocks, your privates, your whole net worth on a page, Power BI.
Wow.
Before Power BI. And so I built it because it was a problem that I didn't have a solution for from my advisor. So we started selling it to RIAs and it was shooting fish in a barrel and they didn't have it. And then one of my clients 2 years in from Michigan came to us and said, listen, we don't want anybody else to have it. I'm like, well, that's not your option. And they're like, well, we'd like to buy it. I'm like, name your price. And so they named their price. I'm like, and I will take that.
Yeah.
So I took the bird in the hand.
And so you took that exit as well.
I did.
Wow.
Yeah.
And so you went from tech project to tech project. How did you make the jump into restaurant?
Well, no, the next one was my last company that I built here in Thanksgiving Point called Access Point. It was the point of access between builders and homeowners. And I was building a new home in Highland. This was when I was working on my RIA software. And we built this beautiful $1 million home. And the builder had all the use and care manuals and data and information. They were stuffing it in drawers and putting it on top of an appliance. I'm like,
Andrew, they still do that.
Wait, no, I know. So check this out. I'm like, that's the dumbest system. What if my kid kicks a hole in that wall? What's the color of that paint?
Yeah.
And they're like, well, you just call us. I'm like, what if you disappear?
Yeah. Mm-hmm.
And so I'm like, this is stupid. I'm going to build a system. And that was my company.
And
so I built a system, aggregated all the data in the whole building industry. and then created it for homeowners to work with their home builders, put all their selections in it. We create them a home profile as well as an online profile, and launched my next company. So the dashboard for the RA was for me.
Yeah.
The next one was for my home. And then we sold it to 2,800 home builders. Donald Trump was a client all the way down to local home builders. We had 2,800 home builders. We were backed by Blum Capital
You are
Partners
literally
out of San Francisco.
the definition of a problem hunter.
Yeah. I see a problem and I'm like, that's stupid.
Yeah.
There's probably a better way. And then I create something.
But people need to understand that's where the greatest ideas come from, is when the entrepreneur actually feels the pain.
He feels the pain.
He's
Yeah.
trying to solve.
You're like, I swear I'm not the only one that sees that. And you said they still do that. They still to this day do it. So I grew that for several years, I put my own money in, raised a venture round, and then I raised a growth equity round. And we had a $10 billion firm behind us. And it was a nice little package of funding. And we were in Thanksgiving Point. Life could not be better. 2007, my wife came to me. We had 2 toddler boys, 6.5 and 1.25. And she says, listen, I've been behind you this whole time as you've been doing this entrepreneurial crazy thing. And I feel like I have more to give. I'm like, great. What would you like to do? And she's like, I want to open a restaurant. I'm like, seriously, that's what you want to do? And so I had the same fallacy in my head that everybody else does, and that is they don't work, they don't make money, they all fail.
Yeah,
they're fallacies, and I can rebut any of them. But at the time,
especially today, you've learned that.
Especially today, I've been doing this for so long.
Yeah.
But either way, you'd be proud of me, Tyler, because I said, I think it's a great idea and I'd love to support you. And so I did.
What husband doesn't, I guess.
And because of that, we celebrated our 26th anniversary this year because
Congrats.
I support her and she supports me. But I said, so what do you want to do? And she's like, well, I want to open up a Kneaders bakery and cafe. And I'm like, cool brand. Let's go talk to them. So we went and talked to them. They were here in Linden, the founding family.
She just wanted to go franchise anything.
She just wanted to go try something.
And just get into the restaurant management business.
She's from Alabama. Hospitality is kind of born in their blood, right? Southern hospitality is there. And so she felt like it was kind of her calling.
And Kneaders,
it was a great brand.
It's a good brand. And I like going to Kneaders.
Yeah. I was going to say so did we. And she did too. She was a customer. And I said, that's great. And I said, let's do one up in Highland. And so we went.
So they still had territories left?
Oh, they had not even franchised yet. We started it.
Oh,
yeah.
okay.
There's only 5 of them when we approached them.
Owned by one family?
One by one family.
5 locations, one family. And so you approached and were the first ones to say, hey, we want to own one of these.
I think that they had done one with their sister or something like that in Phoenix or.
So what's the timeline here? Where are we at? What year
this is 2007. Okay.
So this is right during before the
GFC.
Oh, yeah. Wow.
So we literally talked to him, and I will say in that conversation,
how I abbreviated it, the GFC.
It's better to say it that way because it's painful. But when we talked to him, I said, you have 5 units. It's been 10 years since you've been around. Why don't you have more of them? And they're like, well, we've never built a team for scale, and we've also not structured capital before. And I'm like, that's all you need to know how to do to scale a brand. And I kind of simplified it, but I compartmentalized that because I was still the CEO of my tech company. And we were crushing it. And so, we just want to do one up in Highland. That's where our hometown is. So we got the rights to it. Next day, I was driving to work and called the sign that was in front of the new Smith's Marketplace that was being built. And I called them. I said, hey, I'd like to buy a lot out in front. And they said, yeah, it's $1 million. I wired them over $1 million. And we owned a piece of land and we built a building. So we built that in 2007, 2008.
So they let you own the land and build the building for the Kneaders?
Yeah, well, you're just the franchisee. It's up to you if you lease something or if you buy it. And I'm like, well, I want to own the real estate.
Yeah.
So I bought the real estate. And we built the building, and we were done with the building and hiring employees in the summer of 2008. And then in September is when it was. The market crashed again. And I felt like I was reliving the dot-com bubble.
Yeah.
And it was cataclysmic because every day.
You're saying 2008, right?
2008.
Yeah, I know. Yeah. That from August 2008 to
September.
May of 2009 was one of the bleakest periods ever.
Bleakest. But in my industry, though, so you think about this, the banks were failing left and right. Mm-hmm. My industry is dependent on banks funding builders and homeowners buying them.
Yeah.
And all the banks were failing in the
Your tech company.
My tech company.
Yeah.
Because I was supporting that.
You were in the construction business.
I was in that industry.
Yeah.
And so I'm on fire and I'm like, I'm going to fail. Like every day. We had plenty of money in the bank, but still you have the feelings of we're going to fail.
Let's give some sense to our followers and our listeners and viewers. I mean, just what that period was like. What I saw, I was a tech guy, and I got hurt less than others during that period.
Yeah.
If you were tied to real estate, you were going down.
We were tied to real estate.
But what happened was around as we got deeper into 2008, approaching July and August, I was telling some of my friends who had just killed in 05 and 06 in real estate. Just in 05 and 06 was incredible in real estate. And they were telling me they were set for life and everything. I said, are you sure you're going to be okay? Because I'm hearing some things coming out of the East and West Coast and it hasn't hit here yet.
Yeah.
And I'm sitting there and no, we're set for life. Everything's great. I've got so much. And then it depends where they were at in the building phase. Like, you know Scott Peterson.
Very well, yeah.
Scott Peterson had best vinyl. What's the last thing you do on a residential project? Put up a fence. Okay.
That's right.
So, he goes, I got ordered for 3 years. But every single one, and excavators were the first ones to get hit.
Yep.
And I knew people that had bought 2 or 3 excavation vehicles, the big diggers and all that stuff. Those guys, and they had done huge leases, and all of a sudden things were getting canceled.
Oh yeah,
and the project
mothballed, canceled.
Yeah, and then the excavation companies that had done all this work for general contractors and never collected a dime because it would eventually get paid. They got stiffed on everything. It started going, and just everybody, and finally when everything went after, it was, people don't understand. This was, like, you used the word cataclysmic, and you were tied to it too.
I was tied to it. I was tied to it in the 2001, 2002 era, and then 2008. Yeah, 2009, it was awful.
It was bad.
The thing for us too is the builders, of course, they relied on banks. Banks were failing literally. We'd go into the office, we'd put up the screen and be like, WAMU's out, Washington Mutual, Lehman Brothers
which
out.
is huge.
Just big multi-billion-dollar, very
Lehman Brothers.
Yeah.
Lehman Brothers. They're out.
These are 150-year-old
like,
firms.
Yeah. So we were on fire, and I was fearful again. I'm like, we're going to have to consolidate. We did consolidate. We had to consolidate employees. We had to save money. We had so much money in the bank.
Of course, yeah.
And then my wife was opening her first restaurant, October of 2008.
Oh my gosh, October 2008.
So I thought, we're doomed. She opened up, and she was slammed. And I thought,
with
how is
business?
That slammed?
Wow. Yeah.
So I was like,
people
how's that
still have
fair?
to eat.
Yeah.
And that's the thing.
I guess it's recessionary proof.
That's the fallacy that I didn't have in my head, is that everything's correlated to what happens in the world. And when I would go into the restaurant and I would see her high-fiving her employees and her guests and patrons and having fun, I'm like, do you know what? If you watch, the Richards sitting over there in the corner, they don't give a crap if missiles are flying or the market's down 2,000 points. They don't care. In the moment that you're breaking bread with a loved one, a colleague, a family, you don't care.
And
right.
I can't afford this mortgage I overbought on a house.
Yeah.
Doggone, I'm going to get my $15 lunch.
That's exactly right. And that's what people do. It's a nicety.
And it's a way to treat themselves to something.
It is. They'll cut out the Michael Kors purse purchase, but they're not going to cut out going to eat.
Yeah.
So I didn't realize it until I saw it. And then the crazy thing is, I'm on fire for that whole quarter, Q4. I remember getting her first P&L, the end of that first quarter, and I'm like, oh my gosh, what is that number right here? And I remember Shauna saying, Andrew, that's called profit. I'd never seen any profit, John. Like, I'm a tech entrepreneur. It's like, how much did we burn this month? Oh, good, it was less. So I was like, wow, and it wasn't a little, it was a lot. And I was very impressed with that. Well, in 2009 summer, things kind of got a little bit better. May, June, we sold in August. We sold our business.
You sold the Kneaders?
No. We sold our
the tech business.
Yeah.
Sorry.
And I know that sounds crazy, but I called up Shauna and I said, I can stay here as president of the firm, or I can be done and take my chips. And I think I want to come join you. And she's like, seriously? I'm like, yeah, I think I want to come give it a shot. You're looking like you're having a lot more fun than I have. So I joined her. And
just for a better quality of life at the time?
Just to do something different. And I had gone through the dot-com bubble and now the GFC and resale. It's tough on you. And listen, it was another success. I'd survived 2 of the biggest crashes in history. And I was like, I've made money. I've learned a ton, but I just want to try something different. And so when I joined Shauna, I thought it was going to be temporary. I'm like, I'll help her for a while, take a break. We were so busy. And I'm like, Shauna, we should do a couple more of these. And so we went to the family like, hey, can we do 5 of these? And they're like, yeah, sure. We signed another deal for 5 and then set another moonshot. I mean, just to jump to kind of the end, we did 50 of those.
50 Kneaders?
50 of them. And we were 50 of 58. So there's only 58. And we were 50 of them. And we did 87 Little Caesars. We've done 450 restaurants across America.
You did Little Caesars too?
87 of them. We were the 4th largest in that system too.
Yeah. Here in Utah, you were responsible?
No, we were in Southeast. So
did you know Nathan
Louisiana.
Hale by any chance?
Mm-hmm. Yeah.
Because he told me he had like 65 or something at one time.
Yeah, he was huge too.
Of Little Caesars?
Yeah. So we owned that for a while. And it was just her and I and our team. And in 2017, we saw an opportunity where brands were coming to us left and right, one of which was Swig.
Yeah.
They were being introduced to us, the founders, and they're saying, hey, could you do for us what you've done for Kneaders?
Yeah.
And I'm like, yeah, We have the team, the playbook, the experience, and we have the capital. But let's do it in an institutionalized structure versus SPVing it or raising money from John. You and I put money together and do this deal.
Like one time, by the way,
that's a managerial headache anyways.
Yeah, you knew that I was managing partner and very involved with Utah Angels and all the Utah Angel guys. One time Tucanos came to us.
Yeah.
Tucanos, a very popular restaurant here in Utah.
Know them very well. Mm-hmm.
Really well. And they came and wanted to do expansion and things like that. And they only wanted to get investment one restaurant at a time.
Yep.
And we all said, we want to be in the corpus.
Yep.
We don't want to just invest in that location, then this location. And we didn't invest. They went on and did stuff, and some of their locations worked, and some
of them didn't. That's right.
Yeah, and it was really interesting. So I'm just saying it was fascinating when you think about that, because I was saying, well, all the intellectual property, all of the stuff.
It's all at the top.
It's at the top, right?
So that's why we sold. So we sold all of our Kneaders 7 years ago.
I was going to say, Kneaders, you were a franchisee.
You were a franchisee, master franchisee.
Yeah, but you weren't franchisor.
No.
Yeah.
And so we knew that too. We're like, we're building the value of the trademark.
Yeah.
And we're building the value of the IP.
But you don't own it.
We are, but we don't own it.
Yeah.
And we did try to buy it a couple times.
And how did
the answer was no?
How did it end with Kneaders? I mean, you had 50 of them. What happened?
They ended up raising money and buying us.
They did.
Yeah. Even though we tried to buy them and it didn't work out, they ended up buying us. So the founding family bought them back.
They found a financier to buy. They only had 8 locations and you had 50, and they bought you out. Yeah. How did they raise that money? I mean,
that's another story.
Okay, all right.
Okay. And then we sold the Caesars were easy to sell. We sold those because we were franchisees, and I'm like, we're going to be the franchisor or the corpus owner, right? We want to own the IP. So when Nicole Tanner came into me with Swig and she says, I need help. I'm like, great, let's talk about it. I said, well, I'll do it, but I'll only do it if I'm 51% owner because I know what our power is. I know what we can do as a team. And she needed help. She had hit that wall of, I know I have a great brand and this great opportunity. I just don't know how to leapfrog over this chasm of true enterprise value growth.
What is that? Like, what's the walls they're hitting as like an individual restaurant owner?
I'll tell you. So you're 5 units or 10 units or 15 units. You're within driving distance of most of your locations. You got several hundred employees, a couple hundred of them. But when you go to 30 or 50 or 100, you're in multiple states. You have thousands and thousands of employees. You have more tech and more process and systems that you don't know you need to put in place because you have to run it like $100 to $200 million business. You have to run it like an enterprise. Where a lot of people in this industry, they burn their fingers because they're like, well, let's the 3 of us get a Crumbl franchise rights and let's go open them up and let's put an 18-year-old in there and it'll be an annuity for us. I'm like, no, you have to run it like a real business because it is a real business.
Yeah. Mm-hmm.
And so most people, they dabble in food and they don't understand. If you run it like a corporation, you can do $500 million a year and you can kick off $80 million in profit.
Yeah.
So I have a friend who has like 65 Outbacks. He's from Seattle, called Evergreen Food Resources or something up in Bellevue, Washington. And he said he had over 3,000 employees. Yeah. And how he used computer algorithms to find out where to locate those restaurants. Oh, yeah. And he's doing super sophisticated things. Out of the 65, he had 2 failures because they got 2 blocks away from where they should have located it. That's the science.
That's the science of food and beverage.
And so your tech background probably helped you
I've applied so much
of the tech to it. And that's a little bit how I view you, to be honest with you, is I view you as a tech guy who's applying tech management and sophisticated management to a restaurant industry.
Yeah, the 3 things, and I would tell any entrepreneur this, it doesn't matter the industry. It doesn't matter. Think about any of the tech founders that you guys have talked to where people, process, and systems don't matter in every one of those businesses.
Yeah.
So just think about who is it on the team? What's the process you're going to use and what's the system you're going to use to solve the problem?
Yeah.
And within this industry, you have to have people, process, and systems, and all of them are equally important. The other thing that people don't understand is when I got involved in the industry in 2008, 9, I remember having this shelf and there was a fax machine on it and it was printing out catering orders for businesses. They would call up or they would do it online because there was an online tech, but they would come through a fax machine.
Yes.
Yeah.
And there was no tech. COVID, which is surprising. Like we started building our own tech because I can't help myself to help our own restaurants, especially when we were doing Kneaders. But then we got to the point in 2020 where it forced about 5 years of development into like 3 months. Because everyone had to use it.
I was going to ask you, you went through the dot-com bust. Mm-hmm. You went through the Great Recession in 2008. And then I'm saying though, but then you switched to food, but you're not done getting met with things from left field.
In the teeth.
Like people out there listening to this, you got to understand this is a massive operation that faced head on COVID, which wiped out so much restaurant business.
And we thrived.
You survived and then came out of it thriving. So tell us about the whole COVID experience.
Yeah, the COVID experience. And people don't like saying the word even in my industry because everybody's like, oh, you guys failed, right? Like the whole industry was underwater. It's like, it actually wasn't. I would say this, those that decided to pivot and meet the challenge head on, like we did as a team, there was so much opportunity to be met. The reason why is that you had all these families going to their home base and they were stuck at home, right? There was nothing to do. Everything was shut down. But you didn't become Betty Crocker overnight. It's not like you had been cooking meals every day for your family, all 3 plates, during the day. And we knew that. So we closed down our office for 2 days and we're like, what are we doing? We had thousands of employees that depend on a check. We didn't know about PPP money at the time. We're like, we have the resources. We have to stay open. And you and everyone else have to eat. We know it. So if we can keep them safe, keep our employees working, and then keep the lights on, those are the things that we cared about mostly. So we went back 2 days later and we never shut down during COVID. We pivoted.
Were there never mandates in areas or places that you had to?
So we would show up at 7 o'clock in the morning every day, and we sat in we called it the war room for about 8 months because it was the war room. 7 a.m., put up the TV, and we'd be watching what the CDC said on the East Coast because we had restaurants across America. And that mandate for this region was different than this mandate, than this mandate, than this mandate. We would all write it down as executive teams, and then we would break, and we would all go fix what we had to for that day to make sure that we were compliant with CDC rules.
Yes.
And a lot of it was if a place didn't have a drive-through, we would make makeshift drive-throughs. We'd use the drive-through. We put QR codes out. We would make it so that you could scan it, order it. We would have our employees come out, put it right in the back of the car, and you guys remember doing that too. But we did that. We made more money profit. We added 15 more units of restaurants. We closed down none. We limited no hours, and I hired 900 people during that era. During 2020.
Yeah, so I like to always wrap things in a academic teachable box because I like to teach
for sure
about this. So one of the principles, which is really important, there's research going back decades on this, during recessionary times, and that could have been counted as a recessionary time. It was a
recessionary time, yeah.
Okay, the companies that survive recessions by being smart, cutting their burn, doing smart things, bringing technology in to
make it more efficient,
make all the things you did, and that other companies like the tech companies had to also be smart. And in since 2022, with the end of the zero interest rate period to where escalating interest rates crushed the venture and tech world. Okay. Yep. But the companies that quickly laid off 50% of their staff got through it. All the research shows those companies actually emerge stronger than ever, and their market share they capture is amazing. And that's even on advertising marketing. Like in those periods, you have to be careful about cutting out all advertising and marketing, because what the advertising marketing, if you stay at a level, and then when things turn back up in the cycle, you're there top of mind and you're capturing market share. Actually, the ones that survive capture huge market share.
Huge.
And I'm sure you saw that with your restaurant.
We saw it because I would say this too. People have said, what's been the hardest for you? And I said, 2024.
Why?
Isn't that crazy? I would go back and live 2020 and 2021 10 times over.
Why? Because it's
versus 24.
It's unknown?
Because of this. 2020 was an event where there was this pin, just like in the dot-com bubble. It popped it and it immediately blew up. You knew what the problem was, and everybody was suffering at the exact same moment collectively.
Yeah.
The GFC market crash also was similar. It's like it was failing every day. We were all feeling it together. 23 and 24 was hard because if you look at the balloon, there was just pressure from everything in the world, in the ecosystem, that was just putting pressure on all sides, and you didn't know which one to combat.
Right.
You didn't know how to pivot because you're like, well, costs are expensive, build costs are expensive, employees are expensive, taxes are a lot more, property taxes are more, everything was more.
Yeah.
And you didn't know what would give. That makes sense?
Yeah, so it was just the unknown.
It was the unknown. I would
or
almost
the
prefer to
flip-floppiness of the economy.
That's dead. We can't do that anymore. Let's do this and pivot. Where you would pivot, you didn't know where to go.
There were some unique economic times because what was happening was you were having pressure on revenues and expenses were going up, which means usually you're going to have higher unemployment.
That's right.
So you could find employees for cheaper and easier, but that wasn't happening. That wasn't
the case.
All of a sudden you're seeing In-N-Out offer $20 an hour to
People
a
were
worker.
making a tremendous amount of money working for us.
Yeah.
They made more money during that time than we did. The nice thing is that if you have a business that is cash flow positive though, during that time, people couldn't raise money. So you have a lot of businesses going out of business because they couldn't do a follow-on round.
Right.
The nice thing about our industry is we're We're asset heavy. So we have assets. We don't have debt. And if we have any debt, it's very light debt, because that's a smart thing to do, is never have over leverage on your business. But we're a cash flowing business. So where we might be making 25% of margin, during that time we were going down to 18 or 16, but you're still cash flowing. Does that make sense?
Yes.
So we were fine, but we just didn't know where to pivot. So when you say why, we didn't know what to do. No one did. 25 has definitely leveled out, where there's some of the pressure coming off some parts of the balloon.
I think,
and now we know how to pivot and attack.
But I think a lot of industries felt that way because 2023, 2024 with
everybody felt that.
Yeah, with the election and who's going to be in office and what's the landscape going to look like.
If you're not yet profitable and you can't raise any more capital,
you're in big trouble.
Tyler and I, as tech software venture capitalists, the period from mid 2022 till election day of 2024,
rough.
We saw so many horror stories. I mean, and we had people coming at us, and we were only wanting to invest in brand new, cool, great startups that had identified a problem solution and no messed up cap tables and all that. But all these companies did already like $8 million, got to $400,000 burns, lasted 2 years, and are out of money, and they're having to lay off 98% of their staff and saying, "Save us, help us, give us more money." I mean, that's not going to happen, right? But you had cash flow.
We had cash flow.
I go to Via 313 on a Friday night, and I go, "Look at this place. Every table is full, and the foyer is full of people. So guess what? They're got cash flow."
We have cash flow, and people are not going on their vacations, but they'll go to eat still.
Yeah,
so that's what we need.
I get that recession-proof industry that is the restaurant world.
It's
which
just
is awesome.
so non-correlated, and I would say that most of our LPs are we're really deep into tech, we're really deep into CPG or healthcare, whatever.
But Savory was killing it.
They know they need to be in this industry because you can't ignore it, and they like the non-correlated nature.
Can I say
that's why it's always been good.
It's a great diversification.
I want to say one more thing about this. I just asking because it's right. They have to. I also think just each passing decade that I've been alive, because my wife went out to dinner once a year as a child.
Yeah, it's changed.
I had a working mother, single. I went out to dinner 5 to 8 times a week because she didn't want to make dinner. She was too busy and tired. Okay. And all that. But now I see this culture now. I sometimes go to these restaurants, that are expensive, and to take 2 adults, 3 kids out is going to be $100 to $150. And the young 35 and under crowds doing it. And they're still going out.
They're doing it.
And they're not, I don't see them making food at home and preparing their own dinners the same way. And so I think this cultural shift, and the younger generations, maybe they got used to it. I don't know what it is, but I think going out to a restaurant almost feels like an entitlement. You know
I like that. No, it's a good point.
And I think you're the benefactor of your industry, of that movement. And so, are you agreeing with that?
100%. There was a survey that was done in our industry. 67% of the respondents said we depend on restaurants and eating out every week to sustain life.
Wow.
So it wasn't just like just a nicety. It's like we won't survive unless we do.
Yeah.
If you would have taken that 30 years ago, my mom made every meal we ate around the table growing up too in Chicago. It's
not that way.
Tyler's brother's a pretty sharp cook. He's an attorney, and he came to me one time when he was just trying to lose a little weight, and he goes, eating healthy too? Going to the grocery store and trying to eat healthy is so expensive. Not just hard. And he says, this is why these processed foods and all the stuff being pumped out that's not good for you that you do buy and make at home. If you buy that stuff, that's why people get heavy and they get bad health, because it's really bad for you.
That's right.
But he goes, if you really want to try to eat healthy, it's as much for me to make for one person a healthy meal as I just go to a nice restaurant with a healthy meal.
That's right. It's the truth. Especially if you have 2 people at home. If it's me and Shauna and we go and buy all the ingredients and make food, you have all this excess and you're throwing it away. I'm like, that was expensive. It's just cheaper to go eat.
Yeah, just go out to eat. Let's get takeout.
And it's not trying to pump you up. I'm just saying this is a culture shift that's so different. And in 30 years, I sometimes go though, how did they, because 20, 30, 40 years ago, the average young family could not afford to go out to eat that way.
No.
Yeah, it's kind of just the way of life now. You just kind of budget it. You just budget it. It's just what it is. Yeah. Going back though, Andrew, to when you sold the Kneaders franchises and you were getting approached by all of these different brands, how did Savory Fund come into play? Like, how did you actually manage that, pull that fund together, and like actually make moves like, hey, let's make this a restaurant fund? How did you make that leap from selling off Kneaders, I'm now going to be a fund manager.
Yeah. So,
because I just don't think that's a typical fund.
No.
Right? It's not a typical industry.
You had another name. Were you a fund at first or not?
No. So we were Four Foods Group.
So you were a management or consultant firm.
We were just an operations company.
An operations company.
So we just owned everything. We owned the real estate.
So you didn't make the jump to Savory Fund right away.
No. Four Foods Group had their own brands and owned them all, and it was an operating
The Little
company.
Caesars, the Kneaders,
and it wasn't
whatever.
You might have gotten some debt, you might have gotten some investors maybe,
we had a couple
but
investors.
you did not raise a fund
It was all
of other
SPV.
people's money to go acquire others till later.
What
That's
brands
right.
came into the Four Food Group?
So it was Kneaders and it was Little Caesars, and we did a deal with Swig and Mobetta's before we became Savory.
Really?
So we were Four Foods Group. Yeah. The story goes, because you guys know them.
That's Four Foods Group because of those four brands.
Yeah, those four brands. Okay. I was racing Porsche for years, so I did it for fun.
Yeah.
I joined a team, and in the team was several tech buddies of mine from the past. You guys know who they are. They're here local. Some of them are big brands.
Yeah.
Known them for a long time, and so we formed a team, and part of that team was Greg Warnock.
Yeah.
And I remember just the questions always came in and like going, can you make money in food? And I love that question, especially from a tech buddy of mine. And I'm like, I make a lot more than you do. But usually when I tell people, they want to fall off their chair. They're like, you can make that much money. I'm like, well, you have to run it like a business, just like you are too. But no, this is a profitable business model.
Yeah, it's not this passive thing. Yeah.
Greg heard that and pulled me to the side. We were at a race. We were actually on track side. Our zippers were down on our race suits, and we were having a cold drink, and we were just waiting for our next race. And he said, tell me a little bit more about the business and how you're funding them. And so I told him the whole shtick, and it's like, it's the Bank of Andrew and Shauna, and it's, banks that are local that are partners. And I do have some of their large family offices that are backing me on a couple of my different real estate deals. He said, well, have you ever thought about doing this in a private equity stand-up structure, institutionalized structure? And I'm like, I've thought of it. I just haven't done it. I'm too busy. I mean, we were doing $200 million a year in sales and busy and big teams, a lot. I'm like, I'm not going to go figure that out today.
Yeah.
He goes, well, that's what I exist for. I'm like, okay. And he goes, why don't you just partner with Mercado? We'll stand all of it up, use our institutional backbone, our name, but it'll be standalone. And I'm like, cool. So I shook his hand.
Yeah.
And we formed Savory that weekend when we were racing.
And it was your first coming out party, or maybe it wasn't, was the R&R barbecue one in Pleasant Grove when you opened.
Came.
And I was there.
Yeah,
that was
I remember you were there.
That's when you two got together, and that's when that happened.
That's when it happened. So we did
I remember
a
that
coming out party.
event. That was awesome.
It was awesome.
It was a great event.
It was so fun. But we came out, we called it Savory because it's better than sweet. And we raised $100 million. That was our debut fund. That's not a typical debut fund.
No, that's
But
not.
we had a lot of opportunity we saw. And so we jumped into $100 million, closed that up, and then bought 5 brands. And then we raised another $100 million in 2021.
And Fund 2.
Bought 6 brands.
Yeah.
And then we just launched Fund 3 last year for $200 million.
Wow.
And we're a little over 100.
A lot of the same LPs in those funds.
A lot of same LPs. The one thing that I would say about LPs right now, and we're all feeling it, is more capital calls and distributions the last 3 or 4 years.
Yeah.
I'm an LP in several funds, so I feel the same way. And so the amounts of everybody committing are lower, but everybody's part.
Yeah. No, we're managing those LPs and those expectations right alongside
same
with
way.
you.
Everybody wants to be, but the thing is sad is the best time to invest is right now.
Yes.
We're seeing better deals now than I've ever seen.
Yeah.
And so if I think about the times we were most profitable, it was 2009, 10, 11, and 12. The most profitable, most opportunities, best deals on real estate, best people, best everything. And I'm feeling the same feelings of opportunity now.
For us in tech entrepreneurs,
You feel
Exact
that too
thesis
in
of our
tech?
fund.
in tech entrepreneur, so this is what we did. With the minute, I don't know if you remember, it was April 15th to the first week of May in 2022. It was like the rug got pulled out from the venture world. In December 2021, it was insane. The valuations in the tech world and what they're getting. And then all of a sudden, January got a little weird, and February and March kind of hit. But April 15th to the first week of May, we're going, the rug has been pulled out from under this thing, and it's crashing. And that's when we said, we're going to form a fund and see if people believe in our historical track record. And from about spring of 2023 till about December 2023 was the sweet spot. I believe that was the bottom of the curve, the trough. And there's still entrepreneurs forming great companies,
for sure.
but they can't raise money for anybody else.
No.
And we have money, and we did 19 deals.
Yeah.
I think that was smart.
And right now, and some of those deals on just literally less than $1 million have software in hundreds of locations.
Yeah.
That's incredible.
I know. And the value that's creating.
Yeah. Oh, yeah.
Yeah. And now with the advent of AI, they're needing less and less capital
and resources.
So they sometimes are skipping seed, being very picky on Series A, and their valuation's going up. They're creating value, and they just got a little bit of money at pre-seed level. That's our theme.
Yeah,
it makes sense.
It's the right theme, and I'll tell you right now, with any investor, I'm an LP in several funds, and the reason why is because if it's just up to me, a lot of times you'll try to time the market as an individual investor, and investing into someone like you guys or into other firms that I'm invested into that you're also part of. You invest into those because you're like, well, you're going to time it better than me. And then having capital calls over 3 or 4 or 5 years, you're not timing the market. You're taking advantage of opportunities.
I will say this, though. I'm an LP in a lot of funds, too. And I look at what they did in 2021, and I go, what were they smoking?
Yeah.
But everybody was there.
Everybody's
were
there.
all doing it.
But the funny thing is, we like to say, we literally made 0 investments in 2020 and 2021 because I've been through 1 or 2 more cycles than you because I'm older. I went through the Gulf War cycle in 91. Okay. That was also bad. And before that, I lived really early in the early 80s, just before Reagan came in and fixed the economy, and we had the booming 80s. Yeah. So you learn from these cycles, and it's just interesting that, as you learn from these, you just learn, okay, here's coming another cycle. Let's catch it and do it right.
It's the age-old buy low, sell high. In the industry, there's no asset class that is not affected by the macro economy.
And it's super amazing what you've done, though, to do with food and take kind of a mom and pop mentality, apply sophisticated management and how it's coming. Are there other groups around the country doing it?
That's why I think it's so unique.
No, that's why I did it. Because I was in that and we were growing a business, and I'm like, why isn't anybody helping? Like nobody knows what I'm doing. So we did it the hard way and figured it out ourselves. And what I figured is, well, in my tech days, I got really smart people around me. Because I didn't know how to code. I got really good tech guys around me telling me what was possible.
Yeah, you had your roommate do it for you.
So exactly. So I just knew that building the great team around me made a great business, and then you share the pie. And so doing that in this industry, I don't think enough people do it. They just want to be sole proprietors. They want to own everything.
Single
they just
owner
don't
operator.
Grow.
Yeah.
So the skill set of getting something that's curated from one unit, and then they open another site, serendipitously that works. And then you do another one. They get to 5-10 units and they hit a wall of, I don't know where to go from here, but they have an amazing cash flowing business.
So
that's where we come in.
What makes that promising brand? Like what gets Andrew off of the seat in a meeting when it's like, oh man, this could be it? Like, because it's got to be partly the product.
It's the product in the segment. So it's the flavor profile that we know it's hot. We're buying a brand right now that's in the Asian cuisine segment, and we know the Asian's extremely hot. And there's a whole reason behind it, and there's data behind it too, which is G1, the first generation that owns all these Chinese shops across America. G2 they don't want to take them over.
No.
They want to go do something else with their lives. Or if they want to do it, they want to do it cool and hip. Not these little weird, janky places we go for Chinese food. So we've been watching that, and we have one that we're closing on. That's what I was working on as I was coming here in the next couple of weeks, that is crushing it.
So
and it's the cool, hip, new
without
Asian.
revealing too much about this deal or opportunity, or even other ones that you've looked at in the past, like what? So it's multiple locations. It's a hot
14
industry,
units, massive volumes, great cash and cash, great economics, making profits, good team, and an impressive founder.
So basically,
we care about the founder. The founder's a big one.
What are those
too,
attributes?
Tyler.
What are those attributes?
Well, first and foremost, you can't be an asshole. We have a no asshole policy.
That's a good policy.
And I would just say to everybody, just use that as your thesis in life. Being an asshole is really hard to do business with. And you can vet that out pretty quick.
Like just full of themselves and
like this is about me. And when you interview team members, they'll tell you like how it is to work for the guy or the girl. So the founder is important for how they treat their people, the culture that they build, how they take feedback. Are they a sponge or are they a rock? Do they want to listen or do they want to just repel?
Same things,
So it's the same things that you're investing into. And by the way, when I'm investing into tech or into a clothing brand or whatever, because I have investments peppered all over the place, I'm looking at the same thing with those founders too. It's not just us. It's any of my investments. And I think most funds that we're in, I'm hoping they're doing the same thing, but founder's a big deal for us.
I think I'm sitting there thinking about why you've been successful and why you've chosen well on what you're doing is the tech world, though, has the cap stack is more developed.
Yes.
Would you
it
agree
is.
with that
Oh,
statement?
Very, very much so.
So what you've done is you've taken that concept of the cap stack. Like the reason Silicon Valley is what it is because you can go from a 2-person garage startup all the way to an IPO, and they've got everything lined up and the cap stack's there.
Yep.
And we've got that for the tech world now here in Utah.
Yeah, we do.
But not for food.
Not for
what
food.
if I get 5 great locations going in a family-owned business that's got great food, great,
who's my investor,
great
who's my buyer?
concept and all that, and they go, what do I do now?
Well, what do I do with it?
Yeah.
And then we exist.
Yeah.
And there's not competition. If we want a brand, to do business with a brand, we'll get the deal.
Okay. What's one brand that you wish you wouldn't have passed on?
I really like Jason with Crumbl and Sawyer. I think
Yeah.
that they did a great job.
Yes.
At the end of the day, though, they could have burned to the ground too.
Yeah.
Yeah.
Did they approach you early on?
Yeah, I mean, we talked way early when they had, I don't know, one store.
Yeah, like literally their university
Yeah,
store.
and I've known them since then.
But again, they took tech thinking and applied it to that.
Yeah.
And listen,
I mean, Jason's background is tech
it's
too.
tech. Yeah. I think that you don't see that very often in any industry.
Yeah.
That someone can take something.
So
grow
that's
that
one
many
reason
units.
they did what they did.
Yeah. I think that was one that not necessarily I passed on, but it would have been fun to be part of that ride. But that could have gone an opposite way too. They went so fast. I kept on telling them, don't get caught for speeding.
What are they at? What are they?
1,080 units. And then they just sold for over $1 billion.
Yeah, I saw that.
That's crazy.
Yeah,
That's
yeah.
crazy.
And the market has really developed too, John. Like in tech, it was always like, well, there's a 500 list grouping of people that will buy us or invest.
Yeah.
And when I got into this industry, there was probably 100. There's the same. There's 500 plus PE firms investing into this. There's hospitality groups that are big that are investing in this. And then there's also family offices that are saying, listen, we have money in healthcare because healthcare is a $1.5 trillion TAM. Healthcare.
Yeah.
This is 1.1 trillion.
Yeah.
When I got involved in it, it was 600 billion.
Yeah.
Between 2008 and today, it's doubled.
Yeah.
There's not a lot of markets that have grown that big.
Yeah,
it's
yeah,
the
yeah.
second largest TAM next to medical. You can't ignore this industry.
Yeah.
Yeah.
I was in the Yellow Pages industry. I don't know if you know that.
I do know
my
that.
career.
I remember that.
The entire time I was in Yellow Pages, the number one number of advertisers was restaurants. And we just had so many. We made a little bit more money though, believe it or not, from personal injury attorneys on a per capita
Did you
basis.
really?
Because personal injury
Who would've
attorneys, they love to advertise.
Yes, they
and
do.
And they make quick settlements and get all
One
that. But
call, that's all.
restaurants was bread and butter for us in the Yellow Pages too.
Oh, yeah. You gotta
And
market.
yeah, it's a huge industry. That's
Huge
what
industry.
I'm saying is all of the top 10 categories in the old Yellow Page industry were huge industries.
So what I'm learning from this podcast is I need to get out of tech ASAP.
Listen, I still have the itch and I scratch it by making investments myself. And I
Yeah.
sit on a couple boards with tech companies and I apply all that I learned to them too. And the one thing I will tell you that I tell all of them, and I will say to you guys too, and you'll say, yep. And that is bad times when they come, they will pass,
Yes.
but so will good times.
Yes.
Yep.
So when things are going amazing, don't think it's going to just be up and to the right every single day, every single month, every single year. It doesn't happen.
I think my generation learned that lesson pretty hard because I think from 2009 to 2021 was like the longest run up of all
It
time.
was the longest run
and
up.
that was the whole career. That was my whole
That was your
career.
career. No, and I don't blame you for it. But if you think about some brands that are here and nationwide, that these younger generation guys, they literally get on this train. And
By the way, I'm not even
Anyone
young.
under 35. So
I'm 37. I'm not even young anymore.
But no, seriously, Tyler, during the couple, we were going through 2020 and especially 2021, I would, I'm kind of a curmudgeon, I guess, or an OG, which I says
You are an
it
OG.
stands for old guy. And so what happens is I was telling these young guys, I say, you got to understand, we're in bubble territory here, and I've seen this before.
It's gonna
something's going to pop soon, and within 6 months it popped. And Tyler was going, Dad, you can't tell these young guys that what they're doing is not good, and that it's going to be
gonna
trouble
die,
within a year. Because I said, I was at the end of 2020, I was going, this is insane.
Yeah.
What's going on here? And this is not going to end well.
not sustainable.
It's not going to end well.
Yeah.
And for these people, and then in 2022 and 2023, Tyler, he learned over time, this understanding cycles, and people think that venture capital is immune to the cycles of every other asset. Every asset class, you don't fight the Fed. What the Feds do with the interest rates will set every asset class up or down.
Every one of them are tied.
Every one of them. Yep. And that's a lesson you learn in life.
Yeah.
And
you learn it the hard way, honestly.
Yeah.
And I think that whenever I tell an entrepreneur that comes and sits down with me, if I tell him that, and you had not done Dev Mountain, I'd tell you the same thing, but I tell you, when it's good, just be prepared and make sure you hedge for when it's bad.
Which is why
That's all.
why we actually take a lot of early exits out of the investments that we do make in our angel investments, or even within our fund. It's been our strategy. It's like, hey, if we're getting offered a multiple on the money that's been in there, we have to take that.
Yeah, and then it goes and it runs to the moon, and you're like, oh, we could have. I don't do that either. It could have been a zero.
Yeah. It could be nothing. Yeah.
Route's a good example. Just to let you know, we sold early out on Route and made 44x our money.
Yeah,
that's a good outcome.
Big number.
Yes, but that was we were the first investors at a $3 million valuation. Then it went to 160, and we sold. And after we sold, everybody around town, you guys are idiots. Okay, and it went to over $1 billion.
Yeah,
but there's no liquidity event yet. Okay. And they didn't get out before 2021 ended. So we hope the best for Route. We love Route.
They're right above me. They're my neighbors.
Yeah,
I hope that
they do well. They do really, really well. But I'm still not regretting that I sold.
Heavens no.
Yeah.
Back then.
Like you said, what was the quote you said? When you have something in your hand, don't throw it away. I don't know what you said.
When there's a cookie plate going around, you take the cookie.
You take the cookie.
You don't say, I'm waiting for the bigger, better one.
Yeah, let's end.
Two questions.
I feel like we could talk for hours.
Okay, 2 questions though. One, tech, you went to restaurants. Is there another underserved, under-technologized, or whatever you want to call that
industry?
Sector. It's a sector. Not even industry. That's a sector that you think is right for that kind of movement too. Could a tech person take their management skills and go to a traditionally underserved, under technology laden? What is there something that stands out to you? What do you think?
Yeah, the thing that
don't ruin his 2026 plans.
No, he's got so much more to do in food. Yeah.
This is my sunset is Savory, and I'm turning it over to the team. This is my last hurrah. What's what I'm talking to my son about. My son's 25, going to school, married 3 years. He's thinking about business, right? He wants to do stuff, right?
Yeah.
And I'm telling him the same thing, and that is go into the unsexy businesses that are services-based businesses that are not supported by a lot of technology, or the people that own them don't understand technology and don't understand the true essence of people, process, systems, and go round some of those up and implement that.
I feel this is happening a little bit in the home services.
It is.
Home services,
that's been PE's MO forever.
It has, but the problem is that PE and industry in general, it's a herd mentality. So if you get everyone going after that, it runs up the multiple, and then nobody can make money on it.
It's over. So it's kind of like musical chairs. Who's the last one holding?
Who's the last one holding the bag? Yeah.
So this last question then, before time runs out, is leave some thoughts. As I'm a young entrepreneur, 20 to 25 years old, or maybe I'm in my 20s and I've been working for the man, but I've got an entrepreneurial itch. What's like the top couple tips you'd say to somebody like that?
Yeah. So one, enjoy the journey, because the journey itself is probably more valuable to you at this stage of your career than what you're going to make out of it. So enjoy the journey, because you'll look back and go, I was so busy worrying about how much I'm going to make from it, or how I'm going to be the man or the woman, that they don't enjoy the journey.
Yeah.
So I would say enjoy the journey, because I think back about my 20-year-old self and I'm like, man, I wish I would have enjoyed it a little bit more than been so stressed about just making it.
Yeah.
That's number one. Number two, don't skip steps. You can't skip steps. Everybody wants to get from where they're at today to the next big round, to the next big hiring, to get to the big office. Stop, slow down, because every single step of the process builds a great business.
Yeah.
That is so good to tell you about. We have a fellow who came to our Startup Ignition boot camp, and he just was so teachable. He followed every one of our steps. He actually jettisoned the company he thought he was going to do, took the second company he had an idea for. That company's now in the tens of millions of revenue. He and his partner are taking out $1 million each a year. And he is going around our ecosystem and telling all the people that go through,
stop skipping steps.
Don't skip a step.
Yeah.
Do the steps.
So do the steps.
And the skipping the steps is what makes it not work.
That's right.
That's exactly right. What's included in that though? Like, just slow down, make sure you're doing things correctly.
Yeah, and understanding that tripping up is part of the process.
Yeah.
So that's a step. Like, I got to trip up to understand that my position of my business is right for the next step.
Is there like a validation period in the restaurant industry, or
there is,
because in technology, like the lean startup principles, like validate that there's a customer base, that there's a market before you go and build and do and execute, right?
Yeah.
Is there kind of that thinking?
It's the same. I would say for any industry, you don't get caught for speeding.
Yeah.
Like, you can go too fast and hit a wall because you're going too fast. So validate it.
Yeah.
Make sure that the guest in front of you, or your guest that's using your tech, that they're so happy they're going to tell everybody about it. And,
it's just like a car. And when you're speeding in in a car, you use your fuel up faster for how much distance you travel.
Yeah,
so you run out of cash.
So if you're stepping on the gas pedal when your customers are having a 3, 4, or 5 out of 10 experience instead of 7, 8, 9, 10 out of 10,
going too fast.
If you go pour gasoline on that fire, you're going to burn real quick. Versus, man, if you can make sure those are 8s or 9s or 10s.
It's short-lived.
Yeah.
One thing I will tell you about tech is you guys have been tech for a long time.
Yeah.
My company that I sold in 2009, still around 17 years later in Southern California. Some of my same execs
are still there. Yeah.
That's saying something about tech.
Yeah.
My last thing to all entrepreneurs, I would say, is positivity breeds success. Be positive.
Yeah.
Because positivity is what's going to get you through the bad times or the tough times.
I try to tell them, you've got to be positive and sometimes even puff, but also don't believe your own hype if it's not true.
No.
Yeah.
Be a realist. That's right.
Exactly. Hey, this has been fantastic. I don't know what to say.
Love it. Like I said, I think we could talk for hours, but we have to draw this podcast at some point because we've already been going for like an hour plus. So
it's a lot of fun.
Okay, let's cut it off there. Thank you so much, Andrew. It has been so great having this chat with you. Like I said, it sounds like
follow and subscribe.
Yes, follow and subscribe, of course. But I just want to summarize Andrew. It's like he is like the problem hunter in his own life, turns those problems, makes sure there's a market, and goes and implements it in that market. It's insane. It's an awesome insight for all of the entrepreneurs.
What a great lesson for all the entrepreneurs.
So thank you so much for tuning in. It's been a great episode. We'll see you next time. Follow, like, subscribe, everything that Papa Rich says, go and do it. Thank you so much.